we're going to get started right now. So again, my name is Tony Capert. I think if you guys have joined on these webinars previously, you know the deal. You've heard me a few times. Basically, what we're going to do here with Jordan Carter, we're going to be digging into what to look for when acquiring a business, specifically a business selling government professional services to government consulting, government contracting. I think what's a little unique about Jordan's business is they also have a software component as well. We'll talk about, but that's the goal. So I would say if you're interested in buying sort of a services business, this is going to be a great fit and hopefully a good learning lesson. Maybe building off of Nick's previous webinar from before. But also, if you're really interested in selling to government clients, the pros and cons of doing that, obviously Jordan's got experience there too. So let me just give a quick bit of background on myself. I'll turn it over to Jordan and then we'll dig into the meat. Again, my name is Tony. The bulk of my career has been in software. So I built, scaled and sold a venture-backed software company, Contactually. Sold it in 2019. We were a real estate CRM. After I sold the business, got involved in a couple different things, deepest of which has been building an investment fund and a portfolio in vacation rentals. And as well, I got really into the search fund world and started investing in a bunch of different, primarily self-funded search deals. So I'm currently doing about a deal a month. Love to talk to searchers, love to learn about new businesses. And that was sort of the impetus for this webinar series. But Jordan, let me kick it over to you. I'd love a quick 1 or 2 minute intro and then we'll dig in.
Yeah, thanks, Tony, and appreciate you putting this together. Certainly, I think the goal of all of this is to help out searchers and give some insight into certain verticals that you can chase into. I actually thought a little bit about the title of the session is it government professional services or really government facing businesses generally. I think there's like you said, Tony, some good key lessons learned, and it's a great market, really well set up for search and also just self-funded search. So I purchased the business. It's B&A Group last year in July 2020 and acquired it through a self-funded search, raised capital through what then became Search Investment Group. So that was kind of like, in many ways, the foundational acquisition that was supported by Search Investment Group. I'm also a partner there with my 2 other partners, and we help self-funded searchers diligence, target, live deal reviews, work through various issues, and then raise equity capital and structure the debt for their deals, for self-funded search deals. We've also helped independent sponsors as well. So there's a few closings, and we've done 6 deals so far in the past, I think about 12 months, and we've got some more coming. So, but yeah, I'll also invest in Blue Maple behind Tony, and it's just been a spectacular launch out and great year. Good job, Tony.
Yeah, thanks, Jordan. I appreciate it. And I think it's a good maybe segue into why I was so excited to have you on this webinar is you've got the operator lens and hat, and we can talk about that from the professional services as well as the government, working with government clients. But then you've got the investor lens. And so when we're talking about, how are you thinking about good versus great deals and assessing them, I think seeing both sides of that fence, I think could be really helpful in this conversation. So anyway, eager to dig in, and thanks again for joining today. Just a quick housekeeping point before we go on. I guess 2 things. One, this is a webinar series. There's links to a handful of ones we've done in the past. And if you're listening to this, you're probably already signed up and getting them. But if just shoot an email to webinars@bluemaple.co, and you'll keep getting invited to more in the future. My wife and I are actually expecting our 3rd baby any day now. So normally we do them every 2 or 3 weeks, but I'll be on hiatus the rest of the year. So this will be the last one for the year, but we'll pick it back up in January and go from there. And one last housekeeping point. If you have any questions, there's a lot of folks on today's webinar, more so than we could take questions live. If you do have questions or want to dig into a particular area, just throw those in the chat. I'm going to be monitoring the chat throughout the webinar and bringing up questions for Jordan for us to dig more into. So without further ado, this is what we're going to cover. Quick overview on why government professional services. and digging in specifically at what good versus great looks like. And I think that's really the meat of the conversation. What are those metrics or factors to think about when considering acquiring a business in the space? And then talking about diligence items and then biggest lessons learned, and we'll wrap up. So Jordan, I'll kick it back over to you. Why don't you give us the quick teardown on sort of your deal, but maybe actually even before we dig into your deal, like why were you attracted to this industry, and how did the deal come about? And then we'd love to hear about the deal specifically.
Yeah, thanks, Tony. I think it really starts with, and I didn't go over this in my background, but did graduate business school. Before that was in private equity. Before that was doing mergers and acquisitions, investment banking, and the private equity was actually with a aerospace, defense, and government services focused firm called JF Lehman up there in New York. And we were at that time, it's about $1 billion fund. It's grown certainly since. They've raised other funds, but we're looking at middle market private equity, and of course a lot of that is federal facing, defense or federal government services. But I started seeing a lot of opportunity in acquiring good players in these various niches of the broader government facing landscape. That when you do that, there's a lot of different potential acquirers. They tend to be sticky businesses more so than private sector. The downside of that being that they tend to be sticky, right? I mean, it's a slow sales cycle. It's a longer sales cycle, and it takes a lot of red tape and paperwork to get through to secure that newer client. But it really does make an opportunity to build something long-term, super sustainable, and leverage off that. So actually, this was not my ultimate company that I purchased last year was not the first local government facing business that I had looked at. I actually got pretty close on a software business that served local municipalities like cities, and assisted with a compliance requirement actually that they have to put on their residents and their businesses, and the city needs to track that, manage it, send out notices, things like that. It was this little specialization, and it is a specialization in local government, facing as a market. So that really got me excited. Now, that deal, of course, went sideways. That's why I ended up, with this one, and really that got me to verify and validate that there's some actionable targets in this end of the market that are available for self-funded searcher type deals. $1 million in EBITDA. That's not typically a traditional. It's a little too small for a traditional funded deal, but it's very pocketed. It's not hyper competitive as an industry from the standpoint of, you think of like private sector software. It's super competitive, right? It's an even landscape. Everyone's competing on your web browser. They're all competing. There's it's high barriers to entry at some level, but at the end of the day, people can price shop and compare, like look at ERPs or financial systems, things like that face private sector. Everyone's quick buyers and also hunting mercenaries. But this one's a little more relationship driven and stickier.
Yeah, I mean, I think you hit on earlier, the blessing and the curse of selling to the government or selling to any government or large entity. It's going to be slow, so it's going to be an annoying sales cycle if nothing else. But once they're there, they're super sticky, and I imagine that came through in doing diligence in these guys as well as any of the deals you were looking at. One of the things, I would be whenever I'm thinking about, frankly, investing in a different type of industry that I don't know that well, there's like a level of intimidation I have of certain areas, right? Obviously, my background's in software, so that I know like the back of my hand. But when it comes to government service or selling to a government client, I would have hesitation there personally. I've never done it. I've never sold to a government prospect. And so, as you're thinking about someone who's coming totally outside the industry, which you had some experience, sounds like, but this is obviously more in depth than normal. What would be like the biggest takeaways or things to appreciate that will be markedly different in terms of selling to a government client? I know I'm kind of getting ahead of myself to some degree, but obviously the slow sales cycle is one thing, but were there one or two or three other things that stood out as very different, again, selling to a government client?
Certainly. So a big one, and I think it's related to the something that's more uh, well, this is probably shares similarities with certain elements of private sector. If you think about a blue collar services business, that's the way you grow that, right, is territorial expansion. And the way you grow this business is territorial expansion. If you look at, our competitive landscape and our own company, you see this like almost like you drop a target or a pin, and the clients kind of emanate from that central nexus.
Hmm. Based on
So
geography or based on the industry fit?
geography.
Hmm.
So think about the opposite of that being, let's say, like you had, Tony, you built up a real estate software business, right? You don't need to stay in any one geography for that. There's no barrier or network effect of growing next door. Whereas there very much is with, our type of business. So it was actually founded, in on the West Coast and just kind of built from there, just kept growing out. And because clients do ask for referrals or references, who else are you working with? They
Sure.
check you, especially in government services. I don't think private sector necessarily checks you as much. They don't care as much about the logos of, oh, we serve this and that. And, everybody serves Google, everybody serves Microsoft at some
Mhm.
level with some kind of, support software, and puts that logo on their website. They care more about, what is the product doing? What's the service doing? How much does it cost? Whereas I do see cities and towns and water departments, parks departments, police departments, fire departments. They want to know, have you worked with someone I know that I trust?
Mm.
And it's not so much that it's political as it is just, do I know them? Do I trust them? If I gave them a call, would they say they've had a good experience working with you?
Yeah, I
I
would
think that's
guess. I
this.
mean, hence the point you made earlier about like being sticky and very relationship based, and this point about being like very being geographically focused. That makes sense. Sorry, I cut you off. Go ahead.
No, yeah, no, that's it, Tony. Absolutely. So yeah, we're gonna get to it a little bit, but um, those network effects are also kind of, you can see it, but it's hard to diligence from the standpoint of like, what can I do, post acquisition? How can I help the business grow? How can I nurture it and support it, support scalability? How do you quantify that? What is the amount of client referrals you need in a certain area in order to, tangibly be able to grow that credibly? And is it too far if you're, let's say, if you're in Southern California or North Texas, is that too far from Houston
Yeah,
in the Southeast for it to be worth a reference? Like, how far can you jump? How far can the fire jump? Think of that spreading.
mm.
Um, so
It's
again,
almost like I mean, we used to talk a lot about TAM, so the total addressable market in our software world. And I got to imagine in software, right? The TAM, what's so attractive about it is it's extremely large because you can sell. There's not a lot of geographic constraints. I'd imagine in your world, it's pretty clear what the TAM is, at least in the short term, and it's very geographically constrained, very constrained to a certain types of entities. So I'd love to revisit that point around, to what degree, like, how do you really assess what is a realistic TAM of expansion, as well as what's the real risk of not being able, like competitive risk or relationship risk of others that might be in this space? 'Cause it feels like that's pretty, I don't know if it's unique to this industry, but it's certainly true of this industry. Um,
Yeah,
but
yeah. The just on that point, right? I mean, if the bigger the TAM is, the more competition you're typically going to see, right? And even in, so let's take software. If you're looking at a large TAM, ultimately you are building that software platform and it's substituting something else or an entire other
mhm,
market. So just because there's a TAM there, it doesn't mean it's unencroached, right? And I think you do benefit from, it depends on what you're looking for. If you want to compete at that, on that scale, you can do it. And you can end up, as they classically do in pitch decks, right? If I could just get 1% of that giant TAM,
yeah, yeah,
look at
exactly.
what I can do, right?
Yeah.
But in this one is right, it's incremental. And how you scale your business really, it is, share some similarity to like an HVAC business in the sense that how much do you want to invest in sales? Do you want to put kind of some things out there in some of those outer cities in your territory and grow faster? It's kind of up to you as to how much gas you pour in the tank.
Hmm. Let's I want to revisit that point about like addressing, sizing market, addressing sort of competitive risk, and anybody else, as I feel like we're getting into the weeds, and I have a tendency to do this in these conversations. Let's sort of start with the basics. You bought the business just over a year ago, I guess, and you've got sort of the quick stats here, which we can all read. But what, knowing nothing about the business or about this industry, 40% EBITDA margins seem pretty great. I don't know if that's typical or not. Obviously, they got a long track record. But yeah, give me just a little more color on this deal and what really stood out to you as most attractive about it.
Well, I think the things that stood out to me were some of the things that are classical things you should look for in a self-funded search deal,
Sure.
or really search
Sure.
deals generally. Low customer concentration, ideally longer duration relationships with those customers, and not a lot of churn. You don't have to replace that revenue. Good track record, having 20 plus years of history to be able to look at and verify that even through, for example, 2008, 2009, that the company grew, it was stable, if not grew, gave us a little bit of an insight into how it would do and was doing, honestly, through COVID. I mean, we closed the deal in July of 2020, which means we were working in February, March, April. So being able to see that survive, I know at this point now that's added to many people's lists of, at the top of the list is not so much, economic recession resiliency, but also pandemic recession resiliency.
Sure.
And so that was really important to look at. Certainly the profit margin it is again a direct correlation to really the competitive nature of the space, also the value that's ascribed by the clients, by the customers, to your service or product. So it really demonstrates there is disconnect in this broader market of local government services, and there's opportunity for service providers to come into spaces and really perform well and profitably, as they should be rewarded to grow. Right, that's the basics of a healthy macroeconomic system. So yeah, that was the again, the stats are on the left right there of kind of what we achieved, but those were the things I looked at. Also, one thing was that looking at the seller's relationship and involvement in the company is really critical, particularly in a self-funded search deal. We counsel this with our search investment group searchers all the time, which is really identifying, if you're not going to be chief bottle washer, you need to make sure you allocate that, for that cash flow, to hire people to make sure that they can come in and support you to be able to give your best talents and skills to the company. So keeping a margin of safety for that growth to help it scale in the future. But really kind of all those things put together made it an attractive company to pursue.
Yeah, I mean, it sounds like, again, like this idea of this long-term growth, resiliency through downturns, relatively high margin, profit margin, obviously all sounds really good. Again, not knowing anything about the industry, what was the multiple and EBITDA that you guys ended up paying?
Yeah, we were about 5 times.
And what's typical is there? How did you feel about that price?
Well, at the time, and I know a lot of self-funded searchers would probably raise their eyebrows at that, because looking at that multiple, but you look at the other dynamics, again, the resiliency dynamics, the profitability, and what I see is a lot of growth potential across essentially every single vertical that we have that we need to nurture, is ideal. This is ideal for a self-funded searcher, and as the old adage goes, price is what you pay, value is what you get. Sure. I think this has a real potential to be something truly special. So in terms of the price multiple, what we're in is professional services in a certain area where we actually support the city manager or the department heads. And actually, I didn't mention this, but it's grant research, grant writing and grant management for cities. So people typically think of grant writing as for nonprofits, and 90% of the grant writing world is for nonprofits. Nonprofit supporting or helping people apply to nonprofits to receive grant funds. We exclusively focus on the city. We help them with their state programs. So state grant programs that could be for, firefighter equipment. It could be to help build a park or fix a sidewalk in a low-income neighborhood. Or those could be federal programs that are available to cities. So we exclusively work with, again, the city manager, that CEO of the city. So that's our space. There's all sorts of different things you could do in professional services. There's
Sure, where we
engineering
specialize.
firms.
Yeah.
There's all sorts of, anything to support a city ultimately could be a service. But so I don't know about the broader market of what that could be. I think the multiple for this was dependent on the quality of the business itself,
Yeah, and I hear you.
not
I think
industry.
at the end of the day, right, this is a modeling exercise, and how risky do you assess the business to be, and how likely is it that's going to meet whatever growth targets you have. So I think obviously a long track record and success historically, high margin business, like all this helps to de-risk your projections that this will continue to grow at the rate you expect in the future. And speaking of which, it looks like you said EBITDA increase, let's call it 8%. A year out from when you bought the business. What was that historical annual growth called over the last 3-4 years?
We were looking at historical, revenue growth in the essentially like 15%, over the past 5 years, 4 or 5 years, which is pretty spectacular. And it's one of the things that, for a services business, right? And particularly again, for a founder owner led business, the founder owners I have still work with, right? We have a great relationship with the sellers. Let's call them sellers, right? They built a great business, started back in 2000, and at the same time they weren't, and they will openly say they were not actively kind of proactively trying to grow necessarily.
Sure. Hence the plan to bring on the BD folks now. I see.
Yeah, but really, I look back at some of the things I reviewed in diligence, and one of those things was an estimate of the composition of where those clients have come from over the years, and they were dead on accurate in terms of I look at it now, a little over a year out, and it's a lot of referrals, a lot of client referrals, and applying to a few select RFPs that are requests for proposal for cities that are looking for grant consultants. So which is great, but that means that we also didn't invest in proactive outreach of calling on cities. Hey, city manager, what are you doing for your grant strategy?
Sure.
Are you utilizing this channel? We have never done.
On the one hand, that's low hanging fruit, right? Like that you can go in and implement a sales team or business development effort and try to drive more aggressive sales moving forward. But on the other hand, I would think, and this is what I meant to bring up earlier, with an industry and business like this that is so relationship driven and so geographically focused, right? The fact that there's only X number of entities within so many miles of where you've got clients today, I would be nervous that that this would be driven by the owner relationships, and that without that owner in place, there's a huge amount of risk. And so, A, is that assumption right? And B, if it is, like, how did you get comfortable with the pro of great, this is low hanging fruit with BD, but this potentially significant con with elevated risk?
That's a great question, Tony. It's something that I was absolutely top of mind concerned about, as anybody should be. And it's not so much that concern from the standpoint of I was seeing things that were illustrating that was a greater risk, but more so it was just a key question, right? And I think if there's other searcher deals where it's much more not, it's not a relationship based business as much, or it's a product, right? Let's say you're manufacturing a product. They don't care if it's Tony or Christina. They don't really care who it is who's making that product. They know that they're trusting the brand and they want it at that price and they want it with those feature sets. So this is exactly as you said it. If you're going to be concerned about the sellers' relationships and how as a key person they are with their customers, it would be with a professional services business. This is exactly the kind that you definitely want to stay targeted on it.
Sure.
So I
So
looked at
so
it.
so so how did you get? I mean, just very
Yeah.
tactically speaking, like how did you get comfortable with it?
Yeah. So the sellers did a great job over the past few years. And I'd say even the past 10 years of raising up a very strong, what we call it, our directors, our director core, who really, those are the client leads. And the sellers that were really more strategic oversight, advisory, mentoring, helping those client leads grow. So that was true. Now it's a thing you want to diligence by maybe seeing like documents or call records and things like that to show that, hey, the sellers weren't on those calls. They were not the
Mm.
ones talking to that client. It was, let's say Christina, like she was the one talking to the client. That's your client lead. So understanding that concept and getting your hands around it is a big deal. And credit to the sellers. They really put that plan in place years ago to get the company ready to be able to be sold. They knew that that was not going to be able to be sold if it was all them.
Yeah. Is that, I mean, just extrapolating this out for someone who's considering buying a business like this, well, I think what you just described strikes me as fairly unique, right? That a seller would be that proactive and be able to demonstrate that they weren't involved deeply with the existing clients or sales process. That strikes me as an anomaly. So if that's true, what advice would you give to someone who's trying to assess, and they're talking to like and the seller doesn't really have proof, quote unquote, that they've not been involved or not been as involved?
Yeah, so I think I had it on here. It's some in one of these slides,
Get
Tony.
diligent. Yeah, we'll get to it. Yeah.
It's a great question. It's something that and this is true for all businesses. We counsel our searchers with Search Investment Group on this, but you have to assess the people you're working with, and particularly the sellers, as to engage the trust, get to know them. It was difficult for me during COVID to actually get to know the sellers, right? Because I
Sure.
wanted to go to
Your
lunch with
arm's length away. Yeah.
yeah, COVID kind of got in the way of being able to do that, but you want to really get to know them because they're going to know way more about the business than you are. And even over a year in, they still have a wealth of knowledge that I'm still building up, right? And it's
Mm.
just that experience, the 20 plus years of experience. Things come out of the woodwork, situations come up, or let's say one of our partners, our engineering partners, I don't know if we've had a relationship with them necessarily that we should continue nurturing. So they've got a great background there, but it really is some of that's a leap of faith. I know that a lot of us are very numbers people and want quantify. Some of this truly is qualitative, and I think that's where you have to lean on the trust of the seller of your relationship. That's honestly part of your job. It's a big part of your job as a searcher is to be the frontline, uh, assessor of the people that are key
Sure.
to transition to the business. You got to trust them.
And to that point too, I mean, I totally agree with you. It's also, I think, one of the hardest things to figure out because it is more loose, right? It's fuzzy and not something you can easily measure. But I guess to that last point, or this middle point you have here about aligning the team structure to support scale. And I think people try all different things to obviously retain and incentivize that middle management in the companies that they acquire. I assume that you sort of attempted something similar. How did you approach that problem? What type of structure did you ultimately roll out?
Yeah. So what naturally happens, great question, Tony. What naturally happens in founder owner led businesses is let's start it with a founder owner. You did it yourself, Tony. When you start out, you are doing everything. You are creating the email addresses, you're setting up, the marketing, the website, you're just doing everything, right? And to grow that business, you have to start bringing on people. And as you bring on people, you train them up and they start taking over things. But I think what had been built up so far was in many ways the directors were doing a lot. They're doing a lot of everything, including the frontline grant writing. So whereas what we determined is that a client-facing director should think of it as like a McKinsey or BCG or Bain or another consulting firm. That director is not the analyst. They're not the ones sitting there on Friday night working for that client. It's the director comes in for those meetings, right? Or the MD or whatever that is. They come in for those client meetings and manage the relationship, set the strategy, counsel the, let's say the CEO or the board that they're working with. So really, when we think about it, we're thinking about professionalizing and continuing to professionalize a real foundation. But to put it simply, it's really about clearly delineating different roles and giving the directors support staff sufficient to be able to let them focus on what they uniquely can give to their clients, and it can also mentor the junior staff. So
Got it.
we'll get into that.
Was that not the case before? Were they doing a lot of the more junior work themselves?
Yeah. So grant writing, think of grant writing itself as the foundation. That's a very individual contributor type of thing to do in many ways. Now you do work with the city, you got to work with different department heads and engineering firms outside to get schematics about the project that they're submitting to potentially get funds from that grant program to support. But you're writing a grant, which means a lot of budget tables, you're writing narrative, you're integrating data and statistics to support the case. A lot of these grant proposals are 40 pages. They're like research papers, like thesis papers. So it's very complex. These are not simple, fill out an application and submit. Our firm focuses on complex grant applications for big programs that help these cities out. And, it's like anything in life, it's kind of hard to delegate. And the easiest thing is just to do it yourself. So I think that naturally developed, but we had a great team and they're all on board with this new kind of chapter where we are elevating and helping support. And really the directors want to do that. They want to stay at that strategic level. That's where they're best. And where junior grant writers can really pick up a lot of experience getting handed those projects, just like an analyst at Goldman or McKinsey or BCG or something. They need to get that hands-on experience. Well, we got it. We have plenty of it.
Totally. And lastly, then I want to move to the sort of good versus great companies. Did you incentivize with like equity or some sort of upside the directors or whatever that middle tier would be?
Yeah, so we do have incentive programs in place for our senior staff, and actually we're continuing to develop new opportunities for alignment there. And you think about, look on the right side of the page, the scale, growth, business development.
Yeah,
I mean, that's what we're all trying to do, right? We want to build lasting businesses that also are enduringly profitable, right? That phrase, enduringly profitable. And I truly believe personally, this is my management style, leadership style, is that you want alignment with your staff so that they know and they understand and also benefit from that growth. And so they're coming along on board, and they're like, you know what? I actually want, Jordan, I want to go get 10 new clients next year, not 7. I'm like, okay, go for it. Let's do this. Right. And I think that one team mentality is really important to me as we continue to grow this company over the next 20 plus years and onward. And I firmly believe in that, and for an entire layer of staff, not so much just your, let's say, first in command or second in command that is supporting you, but also like think of those directors, those client leads. They should be incentivized and benefit. And the whole team should at some level with a bonus program.
Yeah, I've obviously there's different schools of thought with all of this, and on the one hand, I find myself inclined to say like, yeah, that makes a ton of sense, right? When you comp people or at least bonus them based on their performance, it gives them incentive to work harder and work smarter, bring on business, et cetera. And I think if you're in a role where you're doing business development, that makes a ton of sense, right? You're eating what you kill. However, I've always struggled with those roles. There are a lot of roles, and frankly, probably the folks who are doing like the analyst work or the IC work you talked about, writing those grant proposals, it can be stressful for them. Like they're not revenue generators. They don't view themselves as salespeople or revenue generators. And so it's often stressful for them to know that a good chunk of their comp is tied to some level of performance or output. And so I've pulled back from that in my own team building and really only incentivize folks who are more, call it new client or sales driven. But anyway, I'm always intrigued by how people structure incentive structures, because I think it really can make or break a business in a lot of ways.
Well, on that point, Tony, I think you're accurate in the sense that we both agree, right? For the client facing, the business development focused. I mean, you think of those directors, they really are sales. They're sales uh, folks. I mean, one of the conversations I had with my team was really about that. Is that you are sales, and
Sure.
they don't necessarily think of them that way. And I think it looked like Nick, one of your prior guests here, also had that similar kind of sense, is that they don't consider themselves necessarily businessy or sales.
Yep.
Um, but totally agree there. It depends on the person, especially let's say more that junior staff member. Some of them are really incentivized by that and get excited, even if they're not directly contributing to that growth and they're not the ones responsible for bringing on those new channels. But others are, kind of just want to be compensated for their contributions on those projects. So I think it depends on the person.
Yeah,
Can't go
agreed.
wrong with incentivizing the senior staff, though, the ones who are facing the clients and responsible for bringing that pipeline in.
Let's I want to shift gears to sort of the good versus great conversation. I think this is often really illustrates a what are the metrics that really matter in a business like this? Like how do you assess a business as you're thinking of buying one? And B, like we all want to buy great companies. And so thinking about the trade-off between maybe the good, but the good and great, I think is super helpful. So first, I don't fully recall, but I think these are the same or very similar metrics to what Nick had shared previously, talking about sort of professional services in general. Are these the same ones, or is there anything that's particular, you think, to the government space?
For the most part, these are essentially the same as Nick's, because I think they are perfect. I think they really illustrate that. I mean, his business is private sector focused, right?
Hmm.
And I mean, professional services ultimately comes down. What is professional services, right? It's human beings using typically their minds to develop things of value for a client, and that work is typically billable at some level, whether it's fixed fee or hourly. You can break it down and you can cost that project out. There's no work in process. There's no finished goods. There's no raw materials. It's truly hours spent on target and what revenue you're generating for those hours. So the concept of billable time, utilization of that, I would say, and that's accurate in that you want to look at the biller's time, not so much. You separate that from your management staff or management time. We have some staff that split their time. So some of them have dedicated roles that are, let's say, 20-30% of their job description that is not intended to be billable. And that's okay. So really you want to look at it in context. But I think what a great company looks like, the 75 to 90%, really that's just a super mature version that has a lot of junior talent that's able to contribute value to the client base. And of course, you have more junior talent than you do as a senior client relationship managers. That's how that turns into a 75 to 90% with scale. And some of
Sure.
these, and in fact, a lot of these are kind of with scale. You can actually do this. The leverage ratio of junior hours to senior hours. That's how I termed it. So that was a little different than Nick's. Of just really looking at you can just look at the hourly expenditure of time and look at how many people would you classify as junior talent versus senior talent. You get, again, the point is that you have most of the actual day-to-day billable driven work being produced by well-trained junior staff that have the resources to be successful. That's one of the most exciting things about our company, is we have an opportunity to really professionalize that and track it and qualify our new team members to get them up to speed, 80-20 rules, so that they can start taking over a lot of those day-to-day kind of ground and pound type tasks.
Sure. And maybe this is I think this is the case, but when you're securing a client, you're not billing them. Are you billing them for the hours, or is it more project based?
So we actually we essentially set up a quote for a specific project, because some grants are, $5,000 to write, others are 15 or even 20
Sure,
if you
sure.
loop in engineers. And then we have research as a more of a continual service, and then grant management. So our three verticals are grant research, grant writing, and then grant management. And grant management is post award. So after the city wins a grant, they have to manage it and they have to comply to reporting rules. So that's also kind of more of a continuous flow. You know that the quarterly reports are coming, you know, the documentation requirements. But I think the most variable is probably the grant writing, in the sense that it depends on, is this a water project? Is this a parks project? What's the size of the grant? How big is it that we're going for? And how many different components are they asking for the city to submit?
Sure.
So
Where I was going with that about the project, so it sounds like you're building project based for the most part, instead of using a rough estimate of how much time, how big the project is and how many hours it'll take. It strikes me as markedly, somewhat, I guess, different from the legal world. My wife's an attorney. I think I mentioned this in our last professional services webinar, where I think you often don't see as much leverage in a firm because the firm doesn't have a lot of incentive to do it, right? Like the part, all that time is being billed directly to the client, right? Whether it's a partner or a junior associate. Now, a client might not have a stomach for paying for a lot of partner hours. So that's maybe one reason to improve that leverage over time. But I imagine in your world, if you're billing on a project basis, your objective is just to minimize the cost of delivering that project as much as possible, and that's going to improve the EBITDA margins over time. Am I thinking about that the right way? How you sort of view the leverage ratio?
Tony, great point and great comparison. When you look at an attorney's rate sheets, you see you see the $1,000 plus, right, for really experienced partners and things like that, or $900 an hour. And then for that junior associate, you see something like, I don't know, 300, 250, 200, whatever it is, depending on what attorney firm. So you're exactly right that they've kind of priced that in, so that the firm ultimately is taking in a partnership profit that is probably more lucrative at the partner level anyway. So exactly to your point, they, not necessarily incentivized to be the most cost efficient for
Exactly.
that customer. So this is a good question. And in fact, what we see in the space, and not so much about our company specifically, but what we see in the space is that engineering firms do that, right? They have different tiers of service or of hours that you can contract based on the title of the person, and they have multiple billing rates. We historically have just used one billing rate, so that by definition, if we quote out a project and we say, hey, that's a fixed fee, let's say it's $10,000, yeah, we're incentivized to be as efficient as we can on that. We've also used to be, and it have been for the most part, hourly billable. And so it's just as we accumulate hours, we bill for those hours. So again, it's almost, you're really supporting an efficient and super cost-effective way to deliver those services. But what we see our clients wanting is they don't want what Tony, you're referring to, that unbound, who knows how much this
the hourly, exactly.
They don't like that because they have budget, right? They have their general budget, or the city manager's budget, the parks director's budget. They have to set aside this money to be spent on these services, and they want to know what's it going to cost at the end of the day. And so even those engineering firms, they use those different rates to build up a quote, and they say, hey, that's the fee. Here's how it's going to be billed out. And so the city goes, great. We can allocate this and
we'll
plan
budget accordingly. Yeah, that makes a ton of sense.
Good point.
What Nick brought up this point of cash flow conversion in our last conversation, and I'm blanking on. I don't recall what that meant. Can you unpack that? What that means?
Well, that's another area where I really modified kind of the metric on the left column to cash flow conversion. I think he was saying revenue to cash. I believe he's saying the same thing, which is really not so much specific to this industry as it is really just collectability.
Yeah, so it's like a collections number essentially. Either we're inflating or cutting hours, or you're actually not getting the client to pay, right?
Well, Tony, I would say that that's actually a really good point about, at least our industry. I don't know about private sector, but for government services, and I learned about this in diligence and assessed it, the clients they pay their bills. And in fact, the only way for them to not pay their bills would be for them to go bankrupt as a city. So you think about the collections ratios for private sector or for even consumer facing individuals, you have a certain ratio there that you have to expect that's just not going to be collectible. And for government services, some of them might be a little late, and that is true. There might be some delays in processing those payments, but you will get your check. And in fact, like we've, for our company, we collect, it's effectively 100%. some of them stretch out 2 months, 3 months, maybe, but
Sure.
we just give them a call and they go, oh,
And you
our
don't cut
process.
hours either. I mean, I think that was Nick's earlier point. Is like even if they collect 100%, they're still they're often expecting to bill, like their billables are X, but they're actually only billing 90% of X because they know the client's going to push back. Do you find yourself in that situation?
We don't
Got it.
we don't get that situation. So if that's what kind of his metric was, yeah, we don't really see it here. As I said, it's very much like you build it up, the project, and the client essentially reviews that, and ultimately they have to trust the service provider to know that they're getting a good value. One of the things we track, and we don't get paid as a percentage of the grant, right? That's like an unethical thing to do. In fact, in our industry, is to get paid and rewarded based on how much grant funding actually they receive. But we do track their win rate and what that ratio is, the return on investment. So for all the dollars that a client is spending with us, let's say over 3 years of our relationship, how much grant funding were they able to bring in as a result of our partnership? And often that ends up being in the 40x, 50, 60, 100 times. It's basically for every dollar they're spending with us, they're getting $100 back. That I think is meaningful to our clients and something they track. But ultimately, they have to trust you as a service provider. That's why they check references. What other cities are you working with? Those kind of things.
Yeah, that jogged my memory, and I do want to hop to the next slide in a second. But I would guess if that last point of yours were true, right? That like the ROI of any dollar spent with you are so significant. It's like, well, there are probably lots and lots of other grants or other areas where they could be hiring you to try to capture even more dollars at very high ROI. And so, A, to what degree is that the thinking that the client goes through? And B, assuming it is to some degree, I would imagine expansion revenue is probably a pretty big, significant driver of growth. And how much do you think about revenue growth coming from client expansion, existing client expansion versus net new?
Yeah, great question. So we see various different strategies and relative importance placed upon this as a channel for financing for the cities, for essentially doing what they are supposed to do, which is support their citizens and constituents. Some cities that come on board with us just immediately get it, and they trust us, and they say, hey, BNA, go for it. Let's pursue proactively, aggressively a very high quality grant program, and they end up being very successful very soon. Other cities kind of tiptoe their way into this, and maybe grant funding was left for dead for a little bit on their radar. So they're looking at more tax revenue or other sources, and they don't necessarily trust this path. So they have to be nurtured over time to be shown that this is a great path for them to pursue. So it really depends on that client. That's actually part of a pre-qualification you want to do to make sure a client's going to be aligned with you, that we know we're able to provide value. We know we can get that ROI for you. And it's a matter of, do you want to take this journey with us? We're going to help you out. To your point on the existing client growth versus new clients, we see a really great opportunity to work with our existing clients, even selling our existing software product to those existing clients. It's a pretty nascent software product, and we're still introducing it at this point. It just came out in the past 2 years. We're still introducing it to our client base, and they love it. They see the value. They can see how helpful it is going to be to them to be effective. But that is a big factor in government services, local government services, particularly, which is where I have a lot of the experience here, not so much federal, but I'm sure it's pretty similar in that if you earn the trust of the city manager, they are listening. They will listen to you with regard to, you have a new service. Well, let's take a look. You have a new software product. Well, I'm interested, because you've established a good track record, and that's what this company has in spades. Is a very good reputation. And that's what I mean by a great foundation for growth.
Do you think it's realistic to the business to have 20% of growth coming from expansion a year or two from now?
I do. And that's with you if you essentially maximize that line of effort. In fact, you say 20%, that's pretty much what we were thinking about and targeting. When I talk with my directors, they think we're leaving probably 20 to 30% annual revenue on the table simply just by being busy. We're really busy right now. And those client directors, that's getting back to that staffing point, right, Tony, of if they're doing a lot of that ground and pound, they're not able to be on that phone call with that city manager and say, hey, I know we're working on these 2 projects. There's another one coming due in January 15th. We need to get started on it. So just being able to stay front and centered, proactive, shoulder to shoulder with the client is really important to capturing that revenue. And ultimately, the fact is, if we're producing a higher ROI, then we're aligned with the client as well. So yes,
Yeah.
we're generating revenue. They're generating grant funding to be able to support their projects. That's a win-win. We're one of the very few service providers that a city can have that actually makes them money as opposed to costing. And that is unique to our specialization in this market.
Yeah, no, anyway, I don't want to belabor the point, but it feels like there's a natural path to drive future sales growth through, again, existing customers, given the high ROI you guys are driving. But so shifting gears, I know we've got 2 slides around diligence and then kind of the big lessons learned. I think we touched on a lot of this stuff, and obviously this idea of doing diligence on the team and the profiles of those people. And we talked about seller involvement, obviously. We didn't speak too much about the revenue source composition, and we glossed over the geographic markets. Maybe let's laser in there and go from there.
Yeah, so you want to know about the revenue source, like contribution across our
Yeah,
service lines?
why is that? What's the aha or the takeaway from understanding the revenue composition?
Oh, okay. So that one, on the third row right there,
Yeah, this third
composition,
line,
revenue
exactly.
sourcing. I'd mentioned that. That's may not be very clear though. Those are a lot of buzzwords right there, but really it's understanding, how did you get your clients? I kept asking that question. How do you get
Sourcing,
new
yeah.
clients? How do you where do they come from? And the seller had an awesome slide, very simple, like most things are that are really some of the most salient points you have to learn about a company. It was something like 50% from referrals, another 20-30% from RFPs, and then another, maybe 10-20% from proactive outreach. Maybe they met at a conference and just cold. Like, let's say we had a booth set up and a new prospective client came up and we followed up with them and they said, yes, let's go. Let's set up a scope and get a contract in place. So knowing where that's coming from tells you 2 things. Number one is your referrals. If you're getting a lot from referrals, and that's true, that means you're doing really good work, because those clients are calling those existing clients and they're saying, yes, this firm just executes and does things very well, and really has saved us a lot of time and helped us maximize our channel. But it also signals to you what's available for future growth. So what was not on that list was setting up a proactive, like, business development effort of tracking metrics of how many outbound calls are we doing, how many emails are we doing, and who are we calling, and who's staffed, who's in charge of that, whose responsibility is it. Those things really didn't have a place in the company's history up until acquisition.
Yeah. Now, I think we touched on this earlier with the idea of a heavy referral based business. It's ideal that it shows you've got good product market fit, right? On the other hand, and the clients love you. On the other hand, to what degree is that based on the relationship with the owner versus the company? It sounds like in this world, by vetting that the owner has pretty much delegated a lot of the sourcing to other directors and whatnot, or servicing the clients to the directors, felt like it offset that risk. And then it was just left with, well, great, we get a lot of referrals. It's like a really great, so it's a great business. Anything more, I guess, on the diligence we should spend time on, or should we skip to the lessons learned?
Just real, second thing there, deep analysis of team structure and profiles.
Yeah,
You really want to
yeah.
get to know how the people work with each other. And again, the top row, it's professional services is a relationship driven, people centered business. I mean, that is your product. That is everything. So it can be a hard switch if you've been looking at other types of industries and then you start to look at professional services businesses, to be able to go, the people are the product in many ways. You have to get to know kind of how long have they been with the company, how much more do they want to continue working with the company, what is their role. Really deep diving that is everything from an
Yeah.
internal diligence standpoint.
And to your point, I think it gets a lot of, if I sort of zoom back out, what scares me about investing in professional services businesses is that it feels fairly commoditized, right? It's relationship driven, but it's also, there is no real product apart from the people that you have. And so I think take through that lens, selling to a client base like government, like local governments, where you have just naturally much lower churn, much greater stickiness. To me, at least, it seems to offset some of that risk of being in something that's so relationship driven or so ephemeral. Like the product is more ephemeral. It's based on the people versus like an actual tangible good. But let's wrap. We've got 4 or 5 minutes left. I'd love to just wrap with the biggest lesson learned. Again, we've touched on some of these already, but if there were 2 or 3 things you wanted folks to take away, what are those closing points?
Well, one of the things actually relates, it's not on the slide, it actually relates to what you just said, Tony, which is there's some types of professional services. I know that it's a real big blanket category. It's kind of like saying industrial industry. It's like, okay, that could be anything. It could be automotive, could be water machinery, or it could be anything. But a big thing there is that the type of service we're providing is long-term by nature. It's not transactional. It's not like you just stop by, hey, I need a quick review on this. Okay, I'll call you in 3 years. Our service, and this is something you want to look for, is something that is, again, recurring, repeatable. These are basics of searcher acquisitions, self-funded search acquisitions. You need a reason for that client to stick around. Why would they continue working with you? And especially, let's say we do a successful grant application. That trust that's been built up in those relationships, in many ways, our client directors are seen as an extension of their team. They actually contact our directors and say, hey, have you talked to this department? Have you talked to this department? What are they up to? They're asking us about that. Think about that, right? That's complete opposite of essentially a commoditized service. And so there's a full spectrum really in the government facing professional services landscape of being, let's say, I'm not trying to disparage CPAs, but you might have like a CPA, you use them maybe once a year for taxation, and that's it. You don't talk to them for the other 9 months. So looking at that, really understanding what is the type of service they're providing and the repeatability of it. Number one, though, is this trust of the seller. I hate to say it. I know it's hard to quantify, but you've got to find a way to do it, especially coming out of, hopefully some of the restrictions of COVID. Go meet the seller, go be with them as much as you can. And then this is, again, more general, but just maintain perspective on materiality. There's a lot of things we negotiated back in the purchase agreement that I have not even looked at because it didn't matter. You think it's a big deal, right? Any acquisition, you kind of get really sensitive of what if this happens? What if that happens?
Sure.
The truth is within a range of safety, really, a lot of those things are not super material. Let's see. I think more related, just looking at your administrative support needs to be able to, so you're a searcher, you're coming in, you're trying to buy a company. Do you want to be running billing every month and aggregating invoices? Is that the highest and best use for you? And if not, which I'm pretty sure it's not going to be, you need to find a way to leverage out of that. But in time, the seller himself, it was a husband and wife, but they both said, you really need to learn the processes before you start bringing on support staff. And initially I thought, well, maybe, why is that? Why can't I just bring somebody on right now? I was glad I did. I actually was glad I took some time to get to know it so that I could properly know what success looks like in that role, scope the job description, and really recruit right for it. And then just like things we talked about, long sales cycle, deeply reliant on client referrals and territorial network effects. The clients have complex budget constraints. They have different contracting vehicles. Some of them don't want a contract. Some of our biggest clients actually don't, we're not contract. Even just trying to look at, I remember diligencing the company and saying, hey, which clients are contracting, which ones are not? And I remember the sellers saying, it's not that simple. And now I understand why. Some don't use a contract vehicle. They actually just want to do task orders or purchase orders.
Yeah.
So learning that and humbling yourself as you look at that is a big part of serving the municipal government market.
Well, I think it's man, I know you've only been at this for a year with this, or I guess a year and a quarter. But clearly you guys have it's really very interesting and cool just to hear your story and how you thought about buying the business. Ultimately, what's attractive to you about the space. And I think it sounds like if you can find a business that has the track record and the great fit that yours had, that can be a really great target and a great way to drive growth and wealth creation. So I mean, kudos to you for finding these guys, and hopefully the success continues moving forward. I know we're at the top of the hour, a couple minutes over, so I just wanted to kind of to switch to how folks, if they want to follow up, stay in touch. I mean, obviously here's your cell, I believe, and email. So I guess for folks who are still listening in, if you do have questions for Jordan, I wasn't able to really get to many of the questions that you guys had sent over. So feel free to reach out to Jordan directly. And of course, if you're looking for another perspective to someone to help you organize your search or to be an advisor in that search process, the Search Investment Group SIG that Jordan's a part of can be a great resource there too. And of course, both Jordan and I are always investing in self-funded deals, so would love to be helpful where we can. Jordan, thanks again for the time. I really appreciate it. I feel like I learned a lot, and it was cool to contrast your experience with Nick's in a sort of different but related space. So thank you again. I appreciate it.